All right, so what are the big stop signs? What are some of the big red flags that you want to look out for when you're running a secondary?
For every well-run tender that keeps a team together, there's a cautionary tale about someone who got theirs and got out. The good is Stripe employees selling in a secondary transaction while they've been noodling on an IPO for the better part of a decade. Employees got liquidity, the company keeps building. Their system seems to work pretty well. The bad. Ben, do you remember the company Hopin during COVID?
Ah, yeah, Bufferat.
Their founder sold over 100 million shares across multiple rapid-fire fundraisers. While founders selling during a raise isn't unusual, the pace was. The company raised so frequently during COVID that he was able to sell nearly 17% of his stake before most people figured out whether the product had staying power. The valuation eventually cratered, and the company was sold for pennies. And here's the ugly. Pipe's management team took millions off the table in secondary sales, and then essentially group quit. The people who were supposed to be strapping back in for another tour of duty cashed out and walked away. That's the nightmare scenario every board worries about.
It can't get worse than this. I mean, are there any other ugly situations uglier than this?
Adam Neumann has entered the group chat. By 2019, Neumann had extracted $700 million from WeWork through a combination of stock sales and loans against his shares. All while the company was burning through $1.4 billion in cash with enough runway to last until only mid-November of that year. He sold $40 million in shares during one fundraise, then another $80 million, and then when SoftBank invested $4.4 billion in 2017, Neumann unloaded $361 million more. He used the proceeds to buy 5 personal residencies, invest in commercial real estate, and fund other startups. The company bought him a $63 million Gulfstream. He renovated his office with a sauna and an ice bath. Meanwhile, WeWork had been profitable exactly once in its history, 2012, when it made a measly $1.7 million. When the S1 finally dropped, the public markets saw what the private markets had been willing to ignore. Massive losses, bizarre governance, and a founder who had been leasing his own buildings back to the company. The $47 billion valuation evaporated. The IPO got pulled. Neumann was forced out. And then SoftBank handed him a $1.7 billion exit package, $970 million for his shares, a $185 million consulting fee, and a $500 million credit line to repay his JP Morgan loans. Not bad work if you can get it, Ben.
No, not bad at all, but didn't the company file for bankruptcy recently?
Neumann became the cautionary tale that every VC now references when a founder asks to take more than $10 million off the table. You don't want to go bankrupt. Not because founder liquidity is inherently wrong, but because $700 million in personal liquidity from a company that had never figured out how to make money was a 5-alarm signal that everyone chose to ignore. These stories matter because they shape the rules. Every time a founder abuses secondary liquidity, boards tighten the restrictions for the next one. And every time an SPV blows up, companies add more transfer restrictions to their bylaws. The bad actors don't just hurt themselves, they make it harder for the people who actually need liquidity, like the employees, to get it.
All right, so where do we go from here? What's next?
There's one more chapter because everything we've talked about so far is the venture side of the story. Employees selling shares, early investors finding a way out, companies running tenders. But the biggest structural shift in the secondary market is happening one layer up, at the fund level. A GP-like continuation vehicle works like this. A private equity firm owns a company inside a fund. The fund is 10 years old. The company is performing. The GP doesn't want to sell it because they still think there's some more value to create. But their LPs need liquidity. The fund term is expiring. Remember, those pension funds have obligations. Those endowments need to endow. So the GP brings in a secondary buyer, someone like a Harbor Best, to put together a transaction. The new buyer steps into the deal as an economic partner, the GP keeps running the company, and the original LPs get a choice. Take your money off the table at this price or roll into the new vehicle and keep riding. Scott Voss at Harbor Best described it simply. It's a tender offer, but at the fund level. We're not selling the company, we're creating an option for new capital to step in and old capital to step out. In 2025, the total secondary market hit $233 billion in volume, like we said, up 53% the year before. And GP-leds accounted for roughly half of that, at $116 billion, with LP-led transactions at $117 billion. 5 or 6 years ago, GP-leds barely existed in mainstream form. Now, TPG estimates that GP-led volume could grow to $300 billion or more over the next decade.
This isn't niche anymore.
We're not in Kansas anymore, and the scale of LP-side secondaries has grown just as fast. Yale, ever heard of them? Sold a $3 billion portfolio into the secondary market. New York City did $6 billion. 10 years ago, the market couldn't have possibly absorbed a deal that size. Now it's just a normal Tuesday. And it's the reason the secondary market isn't a temporary patch. It's becoming permanent infrastructure for liquidity, and it's eclipsing the public markets. The whole game done changed.
So how do you actually navigate it without getting taken?
I think secondaries are really like any tool. You can build something great with them, or you can cut your finger off with a wet saw. The market started because companies stayed private longer and employees needed a way to pay their mortgages with something other than a cap table entry. That problem was legit. The solution, structured liquidity, company-sanctioned tenders, institutional secondary buyers, that's pretty legit too. But $233 billion in annual volume attracts everyone. The operators who care about retention and the grifters who care about fees living somewhere in Miami. The GPs solving a genuine timing problem for their LPs and the ones marking their own homework, that's kind of weird. The firms sitting on the cap table and the ones selling SPVs out of a Gmail account, also strange. But the CFO's job is to know the difference. So if you're running a tender, set the guardrails tight. If you're buying secondary, understand the preference stack. If someone offers you a piece of a name brand company with a 10% upfront commission and no disclosure on the share class, please delete that email. The secondary market isn't going away, it's the plumbing now. More volume than the IPO market, more innovation than most people realize, more risk than most people admit. Use the tool, just watch out for your fingers. I got news for you. The ERP category is finally getting disrupted. And if you haven't heard of Rillet yet, please pay attention. It's the AI native ERP built specifically to replace NetSuite, and it's already won over hundreds of finance teams. Their mission is to make the zero-day close a reality, and they're actually doing it. We're talking teams closing the books at 1:35 p.m. on the first day of the month. Companies like Windsurf, Mercor, and hundreds of others run their entire finance stack on Rillet. Revenue recognition, close management, multi-entity, native Stripe and Salesforce integrations, woo! Everything a scaling company needs. They've got 5.0 stars on G2. They're backed by A16Z and Sequoia, heard of them, and CPA-led implementations that get you live in 45 days. That is simply unheard of in the ERP space. If your books aren't running as fast as your business, check out Rillet. Book a demo at rillet.com/CJ. That is RILLET.com/CJ. That's me.